When finally the markets, as I said earlier, once upon a time the Dow was over 13,000 and now it's below, but a couple of hours left in the trading day. Anything can happen. It was over 13,000. Steve Russolillo of MarketBeat is here. Steve, what do you think? Give me, it's just your best guess. Nobody has any idea whether it'll actually close above 13,000 today. What's your best guess?
I say yes.
You say he does. He says yes. You can flip a coin, people. It doesn't. He doesn't know any better than you do or I do, frankly, at this stage. Let me ask. You had an interesting piece out in which you called it a complacent bull market. Actually, it was Doug Cass of Seabreeze Partners who called it a complacent bull market. Is the market too complacent right now, or is it got it just about right?
I would say it had it just about right, and now it is. I agree with Mr. Cass in that it is a complacent market right now, and I think there are several reasons why this is happening and why what we're seeing here. First, as you just mentioned, crude oil, NYMEX crude is up to $110 a barrel. That means that gas prices for you and I are going up. You're going to see $4 gas very soon, and that has
the drag, the consumer drag. Okay,
yes,
okay, we get that argument.
That's a big argument because if that really drags on the consumer spending drops, and then all of a sudden that has an impact on the broader economy. But that said,
let's talk about the way the market has gone up over the last couple of months since the start of the year. It has not been. It's been a grind. I mean, it's kind of grinded its way up. The S&P up 4 points one day, up 8 points, takes a little down, goes up 12 points. It has not been a, one big headline, one dramatic move in the market.
Oh, absolutely.
It's kind of ground its way up on relatively light volume. Is that good if you're bullish, or is that bad?
The bulls would say that that is a sign of a healthy market. You'd much rather see those sort of trading patterns as opposed to what we saw in 2011, where up 400 points one day, down 400 points the next. Just so much volatility, not necessarily a sign of a healthy market. So this does show that things are getting better, but the market seems to keep grinding higher in the face of good or bad news. It doesn't matter what's coming out, whether it be out of Europe, whether it be earnings. The earnings picture here is slowing, and a lot of people said that the reason why the market was flat in 2011, not down, was because earnings were still pretty steady, even with all the volatility in Europe. Now you're seeing the earnings growth rate, or the projected growth rate now for the next few quarters, is going to be much smaller than it was over the last few quarters.
Right.
So if earnings are going to come in, if the consumer is going to get hit a little bit harder from these higher gas prices, that just means companies are going to be even more cautious, and you can make the argument that the stock market is not pricing in these concerns.
And yet, the so-called smart money, I think I just read a study came out that said the hedge funds, again this year, are way behind the broader market indices because they have been quote-unquote hedging. They have been short the market, or at least not as long as the market, and therefore they're coming up short in terms of their returns. There is a lot of money still sitting out there, be it hedge funds, retail investors. I mean, it's a weird market. You don't have people going, you have to buy stocks.
Exactly.
Even though there's general bullish sentiment, it's not like people are putting their money where their mouth is. The rises have been very tentative.
It's a great point. If you think about when the Dow was last at 13,000, or you think about when the Dow was at its all-time highs, everyone was cheerleading, everyone was pumping stocks. Now it's the exact opposite of a euphoric mentality. Now it's like, wow, the Dow's back up at 13,000? When did that happen? How is that possible?
And no matter how you slice and dice it, I mean, I take your point on earnings, but the reality is you still, you need multiple expansion. If your earnings are totally flat, let's say earnings don't grow at all this year, which I think is unlikely, but let's say they don't, then all you have to believe is multiple expansion to justify the share price. I mean, you're still below the traditional market multiples in the market right now. Now, I'm not saying you shouldn't believe that. All I'm saying is you don't need a lot of earnings growth to justify the current share price levels.
That's fair. I mean, the PE levels are certainly, it's not an expensive market right now, so to say. So you're right. I would be concerned, if I was in the market, I would be concerned about crude right now, because the last time we saw such a huge run-up, first of all, it happened in the summer. It didn't happen this early in the season. And if you're already seeing crude at around $109, $110 a barrel, at least on the NYMEX, I'm worried about what kind of broader implications that's going to have for the economy. And couple that with any more shocks that come out of Europe. Obviously that the second bailout for Greece has, made people a little bit more optimistic that Europe kind of has its head wrapped around these problems. But you know, they're still worried of that big shock though. So.
Yeah, very interesting, especially because everybody also got the dollar-euro relationship wrong. Since the start of the year, the euro's rallied against the dollar like 3 or 4%, which is nobody predicted that. Steven Russolillo, Market Beat, thank you very much.